Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our Strategy of the Week update here for January or June 9th, 2022. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. Um, Obviously, I have a lot to talk about, mostly soybeans today. No real news that has hit the markets outside of, I guess, flash sales this morning. That certainly, that could be a major proponent and a reason why we continued higher. Those sales for new crop beans, however, to unknown destinations, not enough, to justify, I think, like a big, how big was that move today? We started off with a low of 1730 and we got as high as 86. A 56-cent move on the back of that is a little weird. We don't typically see that big of a move due to a flash sale. Export numbers were actually not that great. It's a slow time of the year for exports, with most of the global buyers turning their heads towards South America. But interesting dynamic going on, and at least in Argentina, and I'm sure there's similar things going on in Brazil that justify keeping grain in the bins. There, but Argentina, their government's looking to levy a tax against, grain conglomerates and any corporation selling agricultural products or exports for a profit at massive percentages. So that might actually entice people to not be sellers on that global scene. And the idea is to try to curb inflation domestically by keeping all of that corn and soybean for domestic crush purposes to make ethanol and biofuel, as well as for that domestic feed demand. We'll see how that plays out. Move like that we saw today in the soybeans always makes me wonder, does somebody out there know something about tomorrow's report, the WASD coming out, that we don't? That's all speculation. I have no idea, but a big move ahead of a report like this, it sometimes worries me, because it's almost like the market's setting up for a buy the rumor, sell the news type of event. We're at a seasonal time of the year where we oftentimes find a high in price that is then walked back and consolidated against that high, into the pre-harvest low or that late summertime low like we had last year. I would not be surprised to see a very similar type of thing happen this year. But let's go over the charts and let's begin with soybeans today. All right, so that July soybean finishing the day at 1769 even. That's up 29 cents. Pretty impressive rally. I didn't like how we fell, off the highs by about 16 cents there. Certainly, anytime we break out of consolidative ranges, it makes sense for the market to come back and test that old resistance now as support. And that could be, down into that 1740, 1730 area yet again. But there are some fibs and some other things we'll look at. Daily RSI is now overbought up into the 1.0 territory. Not a reason to be a seller per se, but anytime we're overbought for an extended period of time, like we've generally been since the beginning of May, where we began the rally from the low end of the range below $16 and now have pushed in June to a new contract high, it does, you have to be playing the devil's advocate when you start to see momentum get, to that point. And think about trailing stops, right, and protecting gains if we have them. 18-day moving average down around at 1702. That's going to be dragged up a little bit here. I wouldn't be surprised to see even a pullback to that magnitude to test that 18-day moving average. But you can see here the consolidation we had through the start of May and into the end of May definitely respected that level as a technical support. 55-day moving average at 1666 and the 100-day down at 1624. Not even worth talking about that 200-day all the way down at 1462. Pretty impressive that those are all getting dragged up as much as they are. Okay. November beans might actually be a little more technical in terms of the levels that I could find that justify, the move we've seen here today. And also, November beans was pushing to new contract highs and holding on to them for before July did. And that, I think, just speaks to the volatility we have in old crop right now. But as you can see, we never crossed back over that 18-day below the 55-day moving average, which we actually did for a brief moment there in July. but it was quickly, taken back. And arguably November at actually a higher relative price than the July, although we're seeing some immense bull spreading. We'll look at that spread here in a little bit. So now, pull back to 1550 here to test this old resistance, the old contract highs from February, the test those highs in April, and that new contract high we made there at the end of May. A pullback to test that area now is support, which is probably will align with that 18-day moving average if it stays up here for a little bit longer. Not out of the question, and something we certainly should be thinking about or concerned with to some extent. The July soybeans got a 15-minute chart up here. Certainly a full 50% retracement from today's low at 1728 and a half up to the 1784 high at 1756. Very interesting level. 1760 now to me is that old resistance, certainly the resistance from yesterday that started a pullback that I thought might have actually been a turn in the market. And actually every rally we've had in soybeans, something I want to kind of point out, has been a very, very much a bear trap. There have been technical selling pressure into these rip your face off rallies that really have all happened from, I don't want to say non-technical levels, but they're not respecting Fibonacci poles. You can see here the first rip we had back in the end of May. It came off of lows where we chopped around for a day and a half, and then just the bell rang and we went straight up. We found momentum through the next session and a half to a new high before falling back and just retracing that entire range, only to really hold that trendline support here that began in mid-May and has been respected all the way through, even here into the start of June. Each one of these levels has had a 50% short of some capacity that held off the highs, which is oftentimes a signal that sellers or technical sellers are coming in and effectively picking a top. Very few of them have actually gone all the way to their target before then just ripping back the other way. You can see back here in early or late May that 50% short around 1696 headed lower. There's then a short that kind of began from that high to the low that eventually really just became the powder keg and fuel for the fire. And that rally as stops started to get hit. 50% short off the high here. Didn't quite trade from 1748 down to 1730. That was back at the start of June. And then the market just kind of went straight on up, almost back up to highs. And then, we started to fall back off that high here into this week. From that 1740 high down to that low after, 50% retracement at 1717, held there short, went down, didn't go to targets, held that trend line. Next, a nested 50% here from the 1717s down to the new low, was holding for a session and a half, even looked like it was going to hold there after the bell on the 6th or 7th of June. And then we just ripped up through all those levels all the way up to a new high. After finding that high to the 1760 area, it was at 1758. Coming off that high, we actually started to trade little 50% shorts off the high. Pretty much every 50 back you could have drawn. You can see how they bounced, got reactions. These ones actually were going to, were trading from their entry prices down to the target. You can see that, the first one that I think, you could constitute really did. Held before that 46 area and went down to the 1730 targets here this morning. There's even a nested short inside there, that little bounce that we had from 3 a.m. through up to 1740. Both those trades went to target, and then the market proceeded to, we're going to switch to a 233 tick chart to be able to see some of the price action inside of this move a little bit clearer, so it doesn't look like just straight up. You can actually see some of the ebb and flow we had while the move from lows of the day, let's just say lows in the morning session at 1737 and a quarter up into the highs of the day only took about 2 hours, and we moved from 1737 at about just before 9 a.m. Within an hour we were 50 cents higher, or almost 50 cents higher. I mean, that's a penny a minute. That's a really quick move, nevertheless, we saw the market rip up towards 1750. The 50%, any kind of short now that you would draw from the highs to the lows here was invalidated at their 618 lines. The market then pulled into the 618 line, but didn't break below it here, held it to the tick. The what we would refer to as an ambush long from 1728 highs to 1751, pulled back into the 1740 area, 1737, 618 line held, and then the market ripped out from there. You can now see that the market has started a series of extensions. This, after the market went from 1737 up to its 1756 high, it just continued on through, actually went to its secondary target, and that is the first clue that instead of drawing up from the old entry low to the new target highs as a next in the series pull, where we're going 2 steps forward, 1 step back, 2 steps forward, 1 step back, repeating that pattern, we blew out of those targets. And then on the day here from 1751 high up to that high, that first high after, you can see the first extended 50% that held. Traded down to 1760 there, held, went to targets, and now even though we've broken out of those targets a bit and started to pull back, same anchor, new high here is the support that we held here right into the end of the day. So if we do slide a little bit lower, there's certainly some levels that we can talk about holding. Again, the 50% retracement from the lows to the highs of the day is down around 1756. But they, while we're above 1763 here, very well could be heading to a 1791 target in the near term. This market has gotten some velocity under it. So let's be very aware of that. From the 1689 swing low to the highs after now, the full 50% retracement for this entire move comes in around 1736. That 1736 to 1740 area is very interesting to me still. I'm going to move back out to a 15-minute chart for us because it is this old inflection zone, these old highs that held, and arguably that pullback we held this morning down into 1728 was really just a test of this broken trend line resistance, now as support, and then a move higher. You have to consider that from this little high right here at 1703 highs to highs is what held there for the market, and the support at 1730. It rallied up to 1770, almost got up to 1791 secondary targets, and if that were the case, we would have been drawing this high, a high-to-high extension here from 1757 to new highs, which interestingly enough, when drawn up on the chart, you can make a case for that market, that 50% pull actually trading initially here on that first dip, got a reaction, came back down, tested the 6218 line, couldn't break or settle below it, and still, 1790 targets while we're more or less above the low of the afternoon here around 1766. So tough market to be trading. Some of these polls and the levels I'm talking about are really tough to find in real time, and you have to be quick because of how quickly this market happens to be moving right now. But again, I see support. If we get a pullback towards 1740, be interesting. 1760 is another area I'm interested in. But I'm very fearful, just from a trader standpoint, playing devil's advocate with myself against this bull trend. I'm concerned that we might have a buy the rumor, sell the news type of event tomorrow with this WASDE report, and be finding a seasonal top that sometime between May and July 1st, there's oftentimes a seasonal high, as this has now encouraged anyone who wanted to get sales done to start doing those sales, and it's probably also price rationing out some of the demand. Basis has been strong, cash bids have been strong. We've even got positive bases for corn that were negative bases a few weeks, if not a month or two ago. So there's still the encouragement to get those bushels out of the bin and across the scales, but how high does the market, can it go before commercial buyers decide that I'll wait to buy what I need at lower prices, or at what point does it push hedge funds to the point of wanting to take profits? Have to be considering both of those things, and a news event tomorrow after a very big update like this, knowing that, hey, a pullback is just it's just another move within this trend that could be underway. So we'll see how tomorrow's report pans out, but Yeah, we shall see. All right, looking at July Nove beans now, we have started to break out of our wedge-like structure. It was an expanding wedge here. Um, Traded and settled at 188 over on the day, kind of pulled right back into its old resistance here that it was chopping and chewing through over the last 2 days. But we did trade up all the way to 201 and three quarters, not quite a new contract high. But the market does certainly look like now it's entrenching itself in a channel or something of that capacity to the upside. Um, so I'll be monitoring that closely. Interestingly enough, the 50% pull, not that I follow these on spreads too closely, but it did pull back from 195 down to 163. It held. It's now kind of started to go higher from that new low at 161 quarter to the new highs. You can see how 181 is your next 50% level. So maybe the spreads are still driving price action and driving that old crop bid in a real way. Because, on a day where we're up 29 cents in the July, with news coming out tomorrow that'll probably more likely affect our new crop. It's interesting to see that November beans were only closed up today 14 and a quarter. And then when we turn and look at corn, we actually closed down on the day on December corn. But corn has another interesting look on the chart, and let's move on to that now that we've covered the soybeans. All right, so July corn was trading here into the 55 and 19-day moving average, which have had a bearish crossover. I see that area as actually resistance in the market, and unless we push above 1785 or 785, we'll look at that in a minute. This could be a 50% short off of its high, as well as a bit of a trend line here, and the lack of conviction. There we go. The lack of conviction here by the corn market to break out of those levels and really try to break back above and stay above, even though we closed above both the 55-day and the 18-day moving average here today. It is concerning that we have a 50% short off the highs currently holding, and we'll take a look at that here, in a minute. 100-day moving average down around 721. It looks like the supportive area that gave us support and we bounced off of. So, a move back below today's low and certainly back below the 18-day and 55-day moving average could cause, corn to be in a bit of a downtrend to retest $7, maybe even a little bit below here in the July contract. December finished the day actually red. And by the way, neither of these markets are overbought yet. And the corn, December or July, they're just coming out of oversold. But we failed actually to close above or even break above that 18-day and 55-day moving average, settling back below and dragging that 18-day for a potential bearish crossover with that 55-day is not a great technical sign here. And this is all now since contract highs, again, pulling up into a 50% retracement of that decline, meaning, a retest and a move down towards 650 to 630 can't be ruled out. 100-day moving average at 667 and 200-day down at 601. None of those levels can be ruled out if corn wants to roll over here in the near term. So kind of watch that closely. All right, July corn, got a 4-hour chart up here. This is that 50% retracement from 824 down to the lows at 720. Again, I need to see us break above 785 to feel more confident in the corn rally that we've seen. We have a definite trend line and maybe even a channel coming off the lows that we're going to want to see continue to hold. And again, breaking back below the lows of today, I think is going to call up a retest of almost $7 if it starts to really break down. Downside target of 695 from this 50% short at this time. Taking a bigger step back, though, we can find the supports from the swing 643 low to the 824 high. Support around 734, that 50%. Okay, that's holding. That has enough, and has had and created enough of a bid in this market to put some pressure on the 50% short off the highs. But we definitely are going to have a battle over the trend here between 780 and 720 at this time, and we'll continue to monitor that. The market also pulled back into retesting this old congestion high around 734 to 740. So, all intents and purposes, pretty technical bull trend in the corn that really needs to take out 785 to resume for a move that could take us, up towards new contract highs and what have you. But kind of concerned about corn here and its lack of conviction again to break these levels that you would that the soybeans has had no problem just ripping themselves through. Trendline resistance here on the December corn, kind of holding against the highs, but a swing from the 766 quarter high, contract high, down to this low after, is holding almost to the tick at the 50% retracement. A big reason here at 724. I'm more worried about corn. Definitely have trend lines against the lows that you probably want to follow, and a move back below today's low at 708 half very likely is going to mean we're trading down towards 660, which that's fine. If you've done some sales, as we've been advocating here when we were up in these prices over the last month and a half, any volatility in the downward slide that we'll see, if it happens, of course, is a great reason to do some reownership at this time. So keeping an eye on that, and for a push above today's high to kind of put pressure on the 50% short for the December corn, but we're going to need to see above 735 for me to feel a lot more comfortable there. Unfortunately, I feel like this is just 2 steps forward, 1 step back of a move that could be beginning to the downside. July D's corn, however, obviously trading negative on the day in the December contract and positive in the July, causing a bit of bull spreading here. The market had its old range here between 30 cents over and 50 cents over that we ripped through here today. Seems like we are back on our way up towards the 70 cent over area and the range, that 40 cent range. And of course, above 70 cents over calls into question for us to go back to $1 over. All of that very possible here going forward. Trendline resistance against the highs seems to have broken, but the truth is that this corn spread has just been in a range for 3 months now, and we're just trading back to the high end of that range. Failure to get above 60 to 70, again, another reason to be a little concerned about the bull trend in corn at this time. But again, it's all seasonal. We expect pullbacks this time of year. We expect a contract high to potentially form, price rationing of demand, as well as a lot of producer selling pressure at good prices can cause the market to pull back. And if that occurs, great. We have probably better opportunities below us that we'll take a look at, and we'll justify reasons to be a buyer at some point in time, just maybe not yet. August. So I'm going to go to wheat or the cattle. Let's go cattle real quick. The August feeders, or excuse me, August live cattle, trading back up and arguably right back above that old trend line support that we broke through. Went up to test the 628 line and hit it here at 138. And when you take a step back on August live cattle, 118 lows, the 141 highs, 50% retracement was into the $130, and boy, did we hold it and get a reaction. Cattle, I'd be very interested to see in a pullback towards 134. That would be the new ambush long and a reason to be a buyer there if it so chooses and happens. And then, we would expect from there a swing to continue up towards 146. We'll see if that kind of continues here. We'd also want to see the feeders here in the August contract be the leader, as they are. Full 50% short off of the highs to the new low, though, is we're trading into that 175 area. Really want to see feeders take out the highs of May, as well as the 177 figure to kind of invalidate that. Breaking above this trendline resistance, certainly a bullish development for the feeder cattle. And if we flip on over to our daily stochastics here for August feeders, now into overbought territory at 1.0, so probably getting closer to a top than not. 100-day moving average at 176 is also an interesting area that we are currently holding as resistance. 18-day moving average down around 168, and in a day or so will align with that 50% retracement that I just mentioned. So, okay, turning a little more bullish on the cattle, it seems, and maybe even giving a reason to be a buyer. Who knows? Maybe grilling season is back on again. August hogs, 50% retracement, really held like a champ here from 123 highs down to the lows here at 98. 50% at 111 has held. We've now gone down, broken below any kind of 50% retracement you could draw from the lows to the highs. Arguably, it was holding here, and a reason why we weren't breaking below 105, 104. Now that we've broken through that level, we have to realize that from that 111 high down to the new, we've started a series of shorts. The first one here happened at 108, went down to 104. Next in the series now is going to be from 108 down to the swing low at 102. And because we did take out the 618 lines of all those longs, we have to draw up the ambush short, which if we go up here to 106, looking for that area to be potential resistance, and of course potentially holding trend lines as well if we were to move back up into that area around the 106 figure. So doesn't mean it has to get there. 105.30 is the next in the series, so we could trade up to 105.30 and then back down to 100, or trade all the way up to 106.62. More of the story, as long as we remain below 108, also would be a failure to break back into this range that we are in. Would have a downside target of around 100 as well. And at that point, we'd probably be calling this a very much a short trend, with the market having downside targets of 92.48 from that 111 resistance area that traded. So watching the hogs. Hogs not as good of a look there as the cattle, but they don't have to be in complete lockstep here. So we'll continue to watch that. Wheat is really don't have much to say about wheat. Extension shorts last week, we were looking for that resistance in 170 for continuation lower. It came up, broke the 618 line, didn't really trade a 50% retracement long at any point, but we have just basically come down to fill the gap here. That gap down around 70 or 1045. Today's lows effectively filled that gap. Certainly could get a move higher here and rally from this 1040 area. We've basically pulled back to test the old support area and got a gap still down around 1014.05. I'll just call it 1014. That could fill. So watching this closely. 50% short from this 108 high down to the most recent low. Traded here into the end of the day at 1076. And we also could argue there's a bit of a trend line now against the highs that we need to pay attention to. We start to break above 1082 and 1120. I will then start talking about buying a 50% retracement in the wheat, but because we are coming off the low end of the range that we've been in, that's been between 1280 and $10. But the way this is trading with the next in series short here at 1098, and then even a nested short here at 1077, a move down to targets around $10 is also filling that gap at 1014, probably not out of the question. And with wheat closing negative there for the Chicago, KC, and Minneapolis, I can definitely see why this market has some room to the downside still, but we'll see. We will see, won't we? All right, the last couple of weeks, we've been looking at other markets for good reason. Crude oil being a major driver right now. We've been tracking this kind of breakout here from 115. We went above that area after we broke through that 120, 125, 130, all probable areas for the market to head into. The next in the series long from 111, this is basically headed to target. This series began when we traded from a 93 low up to the 115 high, pull back down to 104, went up to basically targets here at 119, 120. Next in the series from entry low to target high, stair stepping higher, following those prints in the sand, so to speak. 111.60 up to 123. Okay, 90, 123.70. What's a few pennies between friends in a market that's moving $5 to $10 at a time? Next in the series, though, 111 up to these new highs. Look for support around 117 if it comes down there. And by the way, it's also probably a very probable area for the market to retest because it was our old range highs from the 94 to 95 area up to 115. That $20 range had been bouncing since March. We're now starting to break out of that range. So retesting 117, 116 probably in the works for crude here. But it's a reason to buy the dip at this time. New trend lines against the lows becoming a little more aggressive. You can see this market parabolically turning higher. We started with one trend line, and then every kind of subsequent trend line we start to draw through the lows gets more and more aggressive. And to me, the tangent, right? These are all, if you want to look at them mathematically, and if there's a curve of support that is a logarithmic curve or, an exponential curve running against the lows here, each one of these trend lines ends up being a tangent of that curve. That's something I've witnessed and watched occur, and I wish there was I've never really taken the time to sit down and write an algorithm or a program that could actually calculate those out. But I just might, because now we are into these very volatile trending markets where these parabolic moves are occurring regularly. So again, 117 support for the crude. I don't really see us going below 115, but this entire kind of move off the 195 lows to the new highs after kind of can't ignore that a swing from that low to the high after now. Full support's down around 108. So if we break below 115, look for 108 as support, which again would probably align with this with these other upward sloping trend lines that we have against the lows. But I don't think there's any reason to not say that we couldn't get to 150 in crude oil. I think we all hate to hear that, because with basically with it being in a few pennies of a $5 price per gallon national average for fuel right now, and gasoline prices is pretty daunting in terms of the inflation we've seen. So still bullish the crude. Buy the dips, 117 area, 116 probably next support. All right, even the S&P pull back to 4,000 seems like it's in play with today's move. We definitely had what could have been a bit of a range. Let me get rid of some of these fibs here that I've been drawing up, trying to determine where this triangle or range might be occurring from or happening from. At this point in time, I'm going to remove all these fibs because we'll kind of go over what happened on the 4-hour chart. A little bit of a 50% pullback off the lows. That area blew out of its targets. Swing from the high that on that pull to new highs here gave us support and created this bull flag that until today looked very much like a triangle structure, and now seems to be more of an ABC or a 3-wave correction with potentially a triangle as the B wave. So that means A wave was from 4,200 down to the 4070s. Then we began an A, B, C, A up, B down, C up, D down, and then E would have been this rally up into 41.46. Taking that idea and doing a price measurement now, taking the width of the triangle at its widest portion, which would be the A wave there, and extending it. Let me get this right. I got to go just in front of it here. There we go. Taking the width of this triangle and extending it from that, could have been an E wave here today. 100% extension on that is down into the lows that we're almost quickly approaching here at 4,025. The issue, and that's not a reason I'd be a buyer, the issue now is that we have broken the 50% retracement extended long that we were flagging inside of. That's all fine and well to me, because drawing up the full 50% retracement from 3807 low to the highs after has 4,004 as a potential supportive area, and if we continue lower in the near term into that area, that might be the buying opportunity the S&P is presenting itself. The reason I'm bullish on this S&P, even though we're
been in this 3 or 4 5 6 month downtrend, whatever, is that the full 50% short from the 4,800 highs down to the 3,800 lows. That's at 4,300, and we have not gotten there yet. And this 50% pullback into 4,004 has an upside swing target of 4,300, which would take us right up into that area. So it makes sense to me to see this pullback in the S&P as an opportunity to be a buyer, so long as we remain above 3950. We probably are going up to 4300 at the very least. And like I've talked about in the past, I see the current S&P price action is more of 1989 than 2008 or 9. So over the next 10, 15 years, I fully expect the market to not only trade to and through new all-time highs, but probably double or maybe even close to triple its current value. That means going to about 10,000 in the S&P. And we've looked at in the past why that analog that we've been watching of past recessions and how we've behaved, there it fits the profile pretty well for what we're seeing. Mid 80s with Black Monday, which was kind of a false flag financial disaster, and generally speaking, not much of a recession. We then had, Reaganomics, taken over and driving prices to new all-time highs with inflation. And to be completely fair, Joe Biden has had the very similar economic policy of we've got this market's back by just throwing money at all their problems. Going into the geopolitics of some of these policies right now, though, particularly like we were just looking at crude. I should have brought this up then, but the continued release of our strategic oil reserves just means that old Joe is going to have to rebuy all that oil at now higher prices. It's great for the oil industry and absolutely terrible for U.S. consumers, terrible for the U.S. military, and probably, in my honest opinion, one of the dumbest strategic moves we have ever made, with hot conflicts popping off in Russia with the Ukraine, potential for China to escalate certain situations. If the United States needed those oil reserves now, we are tapped out. It doesn't make any sense to sell those off in this time, thinking you can control market price action. And to be completely fair, the market has punished that idea altogether by, crude oil prices just continuing to head higher. All right. So with that being said, the S&P here in a bit of a pullback. I'm not too concerned about it. Looking for support around 4,000 to 3,900. We'll see if it holds down into that area. That pretty much concludes today's Strategy of the Week update. We went through just about everything. I don't have much in the way of trade ideas into tomorrow's reports. Definitely, weekly options are, again, a great way tomorrow and into tomorrow to take a stab at a directional play in the market. For 5 to 10 cents, you can buy pretty close to the money options that, if you're right and we have a big move to the downside or the upside tomorrow, you have the ability to stumble your way into a futures position with at a very minimal cost and completely finite risk. So with news tomorrow, that's about all I would advocate for people to look at. But I am very interested in buying a dip in the soybeans if it comes. Might take a stab at more call spreading at these levels because of how far we've come. And if we're going higher, we'll go substantially higher. So call spreads would still have decent profitability, although they're also gonna come with that ceiling in terms of how much you can make as well. However, 1760, 1756, very interesting area now for me in the soybeans. But if we do reverse this and get below 1750, I'm not so certain I would trust the full 50% long down around 1740 because now the market is just retracing most of today's gains. And there's nothing that could stop the market from having like a limit down or a limit up move after tomorrow's report. But it really feels like this market's getting what it needs to get done ahead of the news. And once the news hits the wire, we're just left with, again, I think after our last reports, when we mentioned, I think we've seen the highest acres and the highest yield projections from the USDA and carryouts for that matter. If that's all confirmed in tomorrow's report, we don't have much in the way until the September and August WASDEs that really matter. In fact, it's not until the September WASDE or even the October one where we'll really see any substantial change on the USDA because they're so slow to adjust their yields. And now that acres are completely baked into this cake, I think that's part of what we're seeing now on the charts meaning that into tomorrow's report, we might be left high and dry without any real good news for some time, without weather markets and other things setting in. Markets are bullish until they're not. A little more concerned with that corn, with the 50% shorts we talked about holding off the highs. And if we do fade off the highs, these new contract highs in the soybeans, which almost every time we make a new contract high, we have a nice 30-cent dip. Great example was 1758s from yesterday, still pulled back 30 cents before ripping higher. Nothing says that we could not see a similar 30-cent dip down to 1756, 1760 here in the soybeans. Can hold it as support, 2 steps forward, 1 step back, or 2 steps forward, 1 step back, and continue our trend higher towards $18 or above. If we do get a little heavy on tomorrow's report, I do fear we could fall back all the way down to the ranges we've seen. But that is great opportunity to be for reownership and otherwise get long this market that into September and October, we'd expect the harvest low to have already been in place and starting a resumption of the trend higher that we saw just like last year. Thanks for joining me today, everybody. This has been your Strategy of the Week webinar. Remember, if you're ever interested in talking more about these trading ideas or how to get an account open or any of the information that I presented to you today strikes you as a reason you want to get into the markets, give me a call, 312-277-0110. That's 312-277-0110. You can find me on Twitter, Facebook, or shoot me an email at dhussey@zaner.com. Have a great day, everybody, and we will see how the WASDE report checks out tomorrow. And if we don't talk before then, have a great weekend, and we'll be back with you as price action develops. Take care, everyone.